Good evening. We start here tonight. The Altron Fintech Household Resilience Index says households in South Africa are under increasing financial pressure due to the rise in interest rates and inflation. The index released its findings earlier today, which show a 1.1% decline year-on-year in household financial resilience. I caught up with the economist, Dr. Roelof Botha, who designed the index, and he largely criticizes the South African Reserve Bank for the manner in which it has handled interest rates, and also suggests that instead of targeting the range of inflation between 3 and 6%, the bank should consider targeting temporarily a new range of between 4% and 7%.
At Altron Fintech, there was a desire to try to find a middle road or a balanced perspective, as you've noticed, from all these different data sets, because one day somebody comes out with a survey which says, oh, we're in serious trouble, and the next day it's not so bad. So that's why we ultimately decided to only focus on quantifiable indicators. So we don't send a survey to somebody and ask them, how are you feeling today? How's your finance? You know, if you've lost money on the lotto or wherever on this betting stuff, you're probably not in a good mood. And if your soccer team has lost, you're in an even worse mood. So this is quantifiable. And as you've indicated, we've got 20 indicators, all of them related to sources of household income, whether that be salary, whether that be profit, rent, dividends, indirectly or directly from investments in unit trusts, etc. And then a couple of interesting ones, civil debt defaults, but we use the reciprocal, and also the credit impairments by banks. So all of these 20 indicators have an impact on household finances. We weight them according to those that are the largest in absolute terms, in value terms, and also that makes the most sense. For your average household in South Africa, the main source of revenue is salary or wages. And that has the largest weighting, but also employment, because a very interesting finding in this one is that even though employment increased in the public sector by 15% year on year, and in the private sector by almost 8%, the average salary in the private sector declined by almost 3%, and in the public sector by 3%. So the finding from the results is very straightforward. Your average salaries have declined. People are prepared to work for less. But the good news, obviously, is that we have created a lot of jobs in 2022.
The index itself having taken a dip in the fourth quarter of 2022, mainly as a result of higher inflation and higher interest rates, is not really a surprise, as we've seen with the rising interest rate levels and the higher interest rates from the Reserve Bank responding, obviously, to higher inflation. That's not a surprise at all.
In the same quarter that the South African Reserve Bank's Monetary Policy Committee started raising interest rates, this index took a turn for the worse. There was a bit of a stabilization in the third quarter last year. We had a very good third quarter of the economy in general last year. That's one of the reasons why the fourth quarter was so disappointing, because of the base effect. But it's going down. It's going down, fortunately, at a very subdued rate, which is good news. But what is surprising is that the Monetary Policy Committee of the Reserve Bank does not seem to understand the nature of inflation in South Africa, because it is not related to people that are rushing to the shops, borrowing lots of money and spending money. The total value of outstanding household credit in South Africa, the bulk of which is mortgage bonds, mortgage financing, is lower today than it was 10 years ago. And this is absolutely frightening. The Reserve Bank did not need to raise interest rates, because the nature of our inflation is because of supply side constraints, COVID-induced, and obviously the global freight shipping rates, which increased by 800% during COVID. And they have come down magnificently, but there's still this lingering on effect. So inflation will drop, whether the Reserve Bank raises rates or not. All they're doing right now is that they're just hurting South African consumers, and especially people with credit.
And you are quite adamant that this is an indictment on the Reserve Bank's interest rate policy and the fact that total household credit extension has not remotely recovered from the effects of the real interest rates that existed before COVID-19. You also believe that the interest rate was higher than normal, than what it should be, even before the advent of COVID-19.
Well, absolutely. Even though some sectors of our economy have recovered to marginally above pre-COVID levels, so we're using 2019 more or less as a benchmark. Tourism is on its way there, international tourism. That has recovered quite brilliantly in the last 6 quarters. It went from 30 to 60 to 80%, which is good, but we're not quite there yet. And the capacity utilization in manufacturing is still lower than before COVID. What this means is that your average factory in South Africa is only running at about 78% of its capacity. The other 22% is standing idle, and by standing idle, also there are no operators on those machines. So what has happened with the higher interest rates is the capacity utilization is now going to decline further. The overhead cost per unit produced is increasing. So what I'm saying here, and this is a fact, I can prove this, is that the Monetary Policy Committee of the Reserve Bank is actually aggravating inflation on the supply side by increasing the unit cost of production by factories. And they cannot, with a high interest rate, convince Saudi Arabia to pump more oil. It's not going to impact on the oil price. And they can certainly not tell the shipping companies to lower their charges. So quite frankly, it was not necessary to raise interest rates, and I'll stand by that statement.
Let's talk about something else that's a sign of a hardship that many households are facing, the financial hardship that the households are facing. And you're talking about here the increase in surrenders of long-term insurance policies.
There's a bit of a paradox here, because in the Altron Fintech Resilience Index for households, the long-term insurance surrenders is actually positive, because it means that whether that policy was worth 2,000 Rand, 10,000 Rand, 1 million Rand, that household that surrendered the policy now has a lump sum coming into their bank account. So it improves their financial resilience right now, but not in future. So from a future perspective, which is not the purpose of this index, it is never a good decision unless you've got no choices to surrender a policy. But this has happened absolutely purely because of hardship. The inflation is one problem, but if the Reserve Bank then raises the cost of interest, of credit, and the cost of capital by 60%, I want to repeat this for our viewers. The cost of credit measured against the prime rate, the prime overdraft rate, has increased now since the fourth quarter of 2021 by 60%. 60. This, as far as I'm concerned, is economic madness.
The diminishing, or should I say, lower levels of remuneration in spite of the growth in the job numbers. We've seen in 2022 positive growth in employment, but the average salaries have diminished.
The average salary a year ago was just about 18,500 Rand a month. That's now including informal sector. For the formal sector, it's considerably higher. It's about 60% higher, in the vicinity of 26,000 Rand. But a year later, that 18,500 has dropped to 16,400. So more than 2,000 Rand a month, every month. That's the average knock that people have taken because of I call it the fear factor and the COVID factor. Because during COVID, many of our viewers will know about this. You lost your job, or you got downsized your salary temporarily until the company started making money again, etc. And one understands that. And I think a lot of people now are still satisfied to rather work at a slightly lower level of remuneration, but still have a job. I mean, that is crucial, is to retain your job. And remember, what you should remember is that many companies have not recovered fully from COVID. They are not at the same level of turnover. They are not at the same level of profit. So they simply cannot afford to continue increasing salaries left, right, and center. If they continue doing that, boom, end of the company. Then you've got no job. So, and people understand this basic economics. So this is actually not a problem. It shows that there's a lot of flexibility in our labor market.